Hey everyone, we're now joined for a one-on-one interview with Matt Klein. Matt is founder of the OVERSHOOT. He's here to help explain why interest rate hikes really haven't done much of anything yet, at least according to many observers. Matt, thanks for being here. Despite higher interest rates, of course, set by the U.S. Central Bank, we still got these pretty high GDP projections in March, calling for strong growth this year as well as next year. We know that Chairman Powell likes to talk about below trend growth, but is there a shift towards more optimistic growth, you think? And if so, why at the central bank?
Yeah, I think it's a combination of more optimistic growth and also a realization that the rate hikes that they've put in place may not have had the impact that they thought they would. So the rhetoric that they've been using for a long time is that monetary policy is restrictive, and that's supposed to mean that, economic activity slows down. And we've seen borrowing slow down. Companies are issuing fewer bonds, are taking out fewer bank loans. Consumers are doing similar in terms of borrowing less. But actual spending and investment has not slowed down at all. Hiring has not slowed down. If anything, we've seen an acceleration in 2023 and into this year. And so you've seen some central bank policymakers, people like Chris Waller, who's on the board, or people like Neil Kashkari, saying maybe actually, we thought monetary policy was restrictive, but maybe it's not. Maybe we should, wait and see. We don't need to actually loosen or lower rates the way we thought we might have to keep things going.
Do you have any concern, Matt, we might hike rates when all said and done before we start the downward trend?
I mean, who knows, right? I don't think that's the likeliest outcome, but it is interesting that we're in a world where we had, basically a little faster than 3% real growth last year, which was very fast. It's much faster than anyone thought was going to happen. And it happened at a time when inflation was relatively tame. It wasn't quite what, the Fed wanted, but it was getting in that direction. You look at the latest projections now based on the available data, which we have a lot of the data for Q1 at this point. And it looks like, basically 3% again for the first quarter of this year. Maybe we don't know what's going to happen in the future, but this is very, very strong real growth. Inflation is not really quite where the Fed wants it to be. So you could argue there's a case for potentially raising rates. But, if you zoom out and you say this is actually a pretty good combination of factors to be in, we think about what people were thinking about before the pandemic, and they were saying the problem we keep having is that growth is too slow, that rates in general are so low that if something really bad happens, you don't have a lot of room to lower rates to get growth going. Arguably, we're now kind of in the good place where, the trend growth rate is such and interest rates are at a level or around a level. Maybe they need to be a little higher, a little lower, but, around a level where actually we have a lot more flexibility. And maybe we kind of solve the problem of the 2010s, which I think would be a really positive thing if that's what happened.
Of course, Matt, when we talk about inflation, there's CPI, there's PPI, there's PCE. If you take the central bank officials at their word that core PCE is most important to track, well, that one is at, right around 2.8%. You could argue that's closest to the Fed's ultimate target, but we still do see those other measures of inflation be a bit hotter than we like, a bit too elevated. What is your sense as to why some components of inflation remain as sticky as they are?
Yeah, so I think basically some of the good inflation numbers we saw last year were, I think, a little bit temporary and reflected sort of one-off factors, kind of in the same way that some of the really bad inflation numbers we saw in 2021 and the first half of 22 also reflected sort of temporary one-off factors. I mean, we had a situation where energy prices really cratered in 2023. That's obviously a lot of that's reversed recently. So, you can't really count on those things too much. Obviously, that doesn't show up directly in core, but it kind of flows through to some things like, airfare tickets and stuff like that. And so I think if you want to kind of see the longer term picture and not what just happened, which is what the inflation numbers tell you, but what's going to happen, you want to look at things like spending power. And spending power is mostly, it's not only this, but it's mostly what people get in their wages. That generally tracks pretty well. You look at changes in wages, changes in what people spend, that lines up pretty well. There's credit is important too. There are other things that matter, but that's kind of the basic. And for a very, very long time, including after the Fed began raising interest rates, the average hourly pay of the typical American worker was rising almost 5% a year, month on month, basically since mid 2022. And despite all the changes in interest rates, all the talk about restrictive policy, that didn't change really at all. Now, the past couple months, it may have ticked down a little bit, but if you have 5% growth for an hourly pay, unless the output that the average worker is producing is rising very, very fast, much faster than it has historically, you're not going to have inflation at 2%. You're going to be having, the spending, people are going to earn more, they're going to spend more, which is, how normally it flows through. And that's going to lead to, faster spending growth. And so from that perspective, sort of the trend inflation rate was probably always more closer to like 3.5 than it was to 2. And so even though we had inflation numbers recording in the second half of 2023 of 2.5 or 2% annualized, that was probably kind of flukish. And so what we're seeing now, I think, is more just a natural reversion to what that underlying trend would be. Now, if wage growth slows down a lot for whatever reason, then that could change. But that sort of seems like where we are right now.
Sure. Retail spending still hotter than expected. The job market's still tight. Unemployment's still sub 4%. I mean, what do you make of the current health of the U.S. consumer? Keeping in mind the points you just made with regards to spending as a primary driver of the kind of weird situation ultimately I think we're in right now.
Yeah, I think we're in a very good situation. It's weird because we haven't had it this good, I think, for a very long time. And so I think it's very positive, actually, that consumers, this is something I think that the pandemic changed. The pandemic itself and then all, the government response to it, which is that there was such an influx of money, especially to people at the lower end of the income distribution, that you didn't need, people were able to spend without borrowing. They were able to build up, emergency levels of cash that they still have. Not quite as large as they were before, but still substantially bigger than before the pandemic. And that gives people, I think, a degree of security and a cushion. I think it's also why you raise interest rates and you reduce consumer borrowing, but it hasn't really led to a meaningful drop in spending. The big category of consumer credit that has really grown a lot less than one might have expected is student debt. And obviously there are a lot of factors there, but I think one of them is that student debt has been sort of a counter-cyclical thing where if the job market's not going well, people can't do other things. That's something that's generally been available to people to take out loans and spend and, maybe wait a couple of years for the job market to get better. And the fact that has really not grown in line with the trend the past couple of years, I think is, reflective of the positive economic environment.
Matt, I wonder what impact you see higher rates having on the overall conversation of corporate debt issuance. Debt raises at the beginning of the year were down 16%. Compared to the same period the year before. And last year, overall corporate debt issuance was down about 48% compared to the year 2020. Obviously, very different fundamental set of circumstances, 2020 versus 2023. But what connection there do you see between higher rates and lower debt raises?
So that is basically that relationship is behaving exactly the way you would have expected, in fact, depending on how you check it, if you look at debt raises, bonds and loans, basically zero right now. There's no borrowing on net by the corporate sector, and which is what you'd expect if monetary policy were tight. It's a big shift. But what's interesting is that hasn't really linked at all to changes in capital spending by company or hiring, which is normally what you do see. You can argue that how that linkage works is ambiguous. You could say companies choose to invest less and then they borrow less as a result, as opposed to they're forced to borrow less. But whatever, I don't know, right? But the point is that we're seeing a disconnect now that's very unusual, where borrowing has gone to zero, capital spending has been very strong, and so again, this sort of is consistent with the idea that rate hikes are behaving in a very different way than they have before, and I think there are reasons for that. And one is that companies, if they're still being very profitable, which they are, if they're getting other incentives to invest, they have been, whether it's like the CHIPS Act or Inflation Reduction Act or other things, that's also going to provide momentum to invest. That should last for a while. Interest rates are temporarily high. And then the other thing I think, which is, a little trickier, but it's not obvious that companies ever needed to borrow in order to invest. They sort of chose to do that, for sort of capital efficiency reasons. But if they don't have to, then, maybe they don't, and what's interesting is that I'm not sure how much these numbers are reflective of, individual companies, but in the aggregate, what the government is currently saying is that the net interest paid by corporations right now is actually a lot lower than it was, a couple of years ago, even though interest rates have gone up so much. And partly it's because they're not borrowing as much, but, that suggests that there really isn't, kind of any pressing burden there.
Of course. Matt, I'm just about out of time. Real quick, if you can, anything else the Fed should be doing in order to slow spending that it's not doing?
I don't think they're actually doing anything wrong. I'm kind of, I guess, I've been in a little unusual position of saying, maybe growth is a little hotter than what people were thinking it was going to be. Inflation's not coming down as quickly, but also that it's fine. I think if we kind of zoom out holistically, the U.S. economy is in very good shape. I think that Fed officials have demonstrated they're willing to be patient and not be too hasty at this point. I think we saw this on the way up when they were starting to raise interest rates. They were not going to be premature and raise interest rates before they were very confident they needed to. And then when they did, they said, okay, fine, we'll go really hard. So I think now we're in a similar situation of, okay, we don't need to lower rates, so we're not going to.
Yeah, we'll need to leave it there. Matt Klein, founder of the OVERSHOOT, grateful for your time. Thanks a lot, Matt.
Thank you for having me.